For years, the narrative was brutally clear. China is uninvestable. The fear was palpable. The selling was relentless and the sentiment was at rock bottom. But while the market panicked, on this channel we did something different. Since 2022, we have been pounding the table on stocks like Alibaba, Tencent, JD and Pinduoduo. We ignored the noise, analyzed the fundamentals and bet on a valuation gap that was simply to disconnect from reality. Fast forward to today, 2025 was the year the uninvestable became the market leader. And our contrarian bet didn't just pay off, it crushed the broader market. But now, the big question keeps coming up. Is the easy money already made? Today I'm breaking down the 2026 outlook for Chinese equity. We are looking at the hard data, GDP forecasts, PE ratio and capital flow expectation to see if there is still fuel left in this rocket. If you want real analysis without the fear, make sure to subscribe to MoneyJourney's channel right now. Let's dive in. To understand the opportunity in China for 2026, we first have to look at the alternative, the US market, which is our standard comparison because the US market is the best place in the world to invest for numerous obvious reasons. Look at this chart. The S&P 500 is currently trading at a forward P of 22, significantly higher than its 30-year average of 17.1. Why does this matter? Because starting valuations dictate future returns. As this scatter plot shows, when you buy the S&P 500 at a PE of 22, the subsequent 5-year annualized return tend to be significantly lower, often over near zero or low single digits. There is a reason for this high PE, of course. EPS growth for S&P 500 companies and US GDP are expected to grow above average. The US market is priced for perfection, or at least there is a lot of confidence in the future growth of earnings, leaving very little margin of safety. Now, let's flip the lens to China. While the US is expensive, China remains the cheapest major region in the world. Look at this data. China is trading at a forward P of just 12.3, compared to the US at 22. That is a massive discount even within the growth sector, which includes our favorites like Alibaba and Tencent. MSCI China growth is trading around 19x earnings, while US growth stocks are demanding multiples well above 30x. We are seeing discounts across almost every sector, from technology to consumer staples relative to the US. JD and Pinduoduo still look extremely undervalued for the fundamentals they are showing. This tells us that despite the 2025 rally, the valuation gap hasn't closed. That's due to the improvement on fundamentals of Chinese stocks as well. The bear case is usually China is cheap because it's not growing, but the data says otherwise. Forecast for 2026 real GDP growth shows China is expanding at roughly 4.5%, while the US is projected to grow at roughly 2% and Eurozone at 1.2%. So, we are paying half of the price for double the growth. Furthermore, the quality of that growth is changing. Look at the breakdown of GDP drivers. Investment is shrinking, but consumption, the blue bars, remains a strong contributor. The economy is successfully pivoting away from property investment and towards the consumer, which is exactly what we want for stocks like JD and Pinduoduo. Speaking of the consumer, let's address the elephant in the room: confidence. It's true, consumer confidence took a massive hit, but look at the recent trend. It is showing signs of bottoming out. The potential for a rebound is huge because of household balance sheets. Chinese households hold 25% of their assets in cash and deposit, and only 4% in equities. If confidence ticks up even slightly in 2026, and that cash rotates from deposits to the stock market, the liquidity injection will be massive. Finally, what does the smart money expect for the next decade? JP Morgan's long-term capital market assumptions project that Chinese equity will deliver annualized returns of over 7% for the next 10 to 15 years, outperforming US large-cap stocks. In previous years, we used to see Chinese Chinese equities in the top of this graph due to its extreme undervaluation. But even after this initial recovery, China is still one of the most attractive markets. Additionally, we have to talk about the dollar. When the US dollar declines, international markets tend to outperform. We are currently at a level that has historically signed a turning point for international outperformance. If the dollar weakens in 2026, as almost everyone in the financial world expects, that is a double boost for our Chinese holdings. So, it is the bottom line for 2026. The US market is priced for perfection, while China is priced for average growth. Yet, the data shows China is growing twice as fast as the West, with a consumer base sitting on a mountain of cash. We believe the momentum we saw in 2025 is just the beginning of a mean reversion that could last years. However, not all Chinese stocks are created equal. There is one giant that we believe is primed to hit $300 per share. In our next video, we are doing a deep dive analysis on Alibaba. You do not want to miss that math. If you appreciate data-driven investing, subscribe to MoneyJourney right now. I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.